Welcome to the 2022 Economic Depression and Preparation Channel. I'm your host, Tony. Thank you for joining me on this Sunday edition, this brief Sunday edition, June 26, 2022. Please be sure to subscribe, tell your friends, neighbors, and cohorts that this is the channel for 100% true financial news in the United States and sometimes beyond the United States here. Today, we briefly want to touch on the markets going up and a dead cat bounce. We want to touch on the formula shortages and other shortages that are paramount to our success, to our planning and our planning success that's going to be coming up in these summer months as the kids are out of school until August or September, and things really ramp up in the housing sector and prices ramp up in other sectors as well. So we're going to continue to keep in our prayers those affected by national disasters around the world. Around the United States and the world, whether it's fires. We had a lot of wildfires and a lot of floods, flash flooding in a lot of different places around the world, and Bangladesh, and also in the U.S. The monsoon season in the Southwest, there's been some slight flooding over there, and fires as well. So people have had struggles over there as well in Arizona, New Mexico, and the Four Corners region. And so we got to keep those families in our prayers. In the meantime, we're going to get right into it, guys. We do have, first to start off as the toilet paper shortage, and then it went to the baby formula shortage, as you know. And then once they thought we got online with that, the factory, again, Abbott Labs, or the people who produce the baby formula, had a fire there, and it went down offline again. And so now we have the U.S. is neglecting its babies. Here's what you can do to help right now. And they want President Biden, to reinstate the expanded child tax credit. As you know, that expired 2 months ago. And so that also is affecting families here. And so we have a lot going on. And not only that, we're going to be coming up in the fall after the summer. We're going to have an upcoming food supply shortage. As remember, the crops that you see in the stores now, that's from last year, the farmers' last year's crops. So this year's crops won't be available until after the fall and winter time. And that's when we're going to start seeing more empty shelves here. So it's just something to keep in mind. They continue to stock up and prepare. Treasury Secretary Janet Yellen, she admits that she was wrong with the inflation numbers, obviously, last month. And she says that the recession, quote, isn't inevitable, according to CNBC, but inflation is unacceptably high. It will continue to be unacceptably high, as we all know. And the Fed's next meeting is around July 13th. They plan on raising rates again, another 75 basis points, according to the Federal Reserve meeting minutes. However, it is possible that they could go ahead and raise it a full 100 basis points, a whole full 1 percentage point, and that would be unprecedented. But if they don't see the numbers, we're going to get the CPI numbers, the Consumer Price Index numbers, and the inflation doesn't go down. If it goes up, then things are going to really change for these markets right now. And so right now, we're looking at inflation at 8.7% and growing toward 9%. We get the new numbers in July. We'll see. I'm not expecting a change. I think it will continue to grow with food and energy costs expanding and everything else as well. Now, the housing market, this is NPR, the housing market squeeze pushes renters into bidding wars. This is so crucial because this is a catch-22 for many families here in America. Those of us who are waiting to buy a house, the millennials, those below, the Gen Zs, the Gen Xers, late Gen Xers, they've been squeezed in the renting bidding wars, because in a lot of cities, if you can't get a house, you have to go to the renting market, or renting a home, or renting a townhome, or renting an apartment or a condo. But those prices are going up now because people are either selling the house and downsizing, or they're trying to be a first-time home buyer, and the interest rates are obviously at 6.3% right now for a 30-year fixed, and growing. That creates a problem, because now each apartment, they call each other, hey, what are you charging? In Chicago or New York or LA or in DC, they call each other and say, hey, what are you charging for a 1-bedroom or 2-bedroom? And this person says, well, I'm charging, I don't know, $1,700. And they say, okay, well, I'm gonna charge $1,750. And so these wars go on and on, because they know that the supply and demand is out of whack right now. It's artificially created supply shortening on the housing market, and it's artificially created demand, because now you have people trying to get out of these houses, either selling these houses because of job or family constraints or other constraints, and moving to cheaper parts of the nation where they won't have so many taxes like they have in Illinois or in Illinois or in California or in other states, or New York. And so now they basically can name their prices in both the builders and developers can name their prices, and landlords can name their prices in renting market and in the housing market right now. But that's going to change very soon. But listen, these guys, if you can't afford to hold out, I'm not a financial planner, I would hold out because look, the guy says, quote, I found the house that I was living in was posted for rent for $2,000 and I was paying $1,400. So this is the game. The game is these developers, these big hedge fund companies, they come in, they buy up, let's say 50 houses in a community tract or whatever. They buy it for a certain price and then they rent it out for a higher price to us. So that's basically the game that's being played in many cities across the United States. And that's what many people are praying for, a housing crash to happen, a correction to happen. More than a 40% correction is what most people want. Even though that means the prices come down and the equity comes down, it will bring this market back to reality because right now you're having people paying more for rent than they're supposed to be paying for a mortgage, like I said. So he's paying $1,400 for a mortgage, but now his rent is $2,000. And this guy's in Port Orange, Florida. This is outside of Orlando, and heading toward Daytona Beach and all that area there, which used to be popular real estate, maybe still is popular real estate for a lot of people down there, down the coast, the Space Coast area in Orlando. So guys, the thing is that if they continue to do this, this is unsustainable because now we have a situation where the average income in America after taxes for a family, for a single person or a family, average median income is around $45,000 a year, and this after taxes. So how can they afford to pay $2,000 of rent? How come all of us can afford to pay $2,000 for renting a house or one bedroom? And it's going to continue to go on because now they think that they can get money for this. So everybody becomes a renter. Like you said, that's in the quote, you will own nothing and be happy. This is what the game is going on. And I don't see how these realtors are going out doing this because now this guy here, he's in Chicago. It doesn't say what area, what part of the city he's in, but he apparently owns one of these buildings and he rents out in Chicago. So he rents this kind of like a duplex, a triplex. He rents this out, and this apartment came open recently. He says, quote, I have so many phone calls that I just stopped answering. Well, yeah, because I mean, people are leaving the high property taxes and they're leaving the high cost of owning a home for some people who hadn't paid off the home, or the home maybe they had a job transfer, or maybe they had a family situation, they had to leave and go into an apartment for a while. Now they're squeezed because now the squeeze play is if you can't afford the high prices of apartment, they kick you out. The foreclosure is a lot more, the eviction is a lot more quicker in the apartments. But the landlords are fighting back, saying that they're struggling with higher costs, quote unquote. They're saying that they got a lot of cost. They spend over $25,000 in repairs and all this kind of stuff because inflation has increased for repair work. And so that may be true to the landlord's credit. That may be true as well, because cost of lumber and everything has come down, but the cost of repairs, the cost per hour to get somebody to do a plumber, electrician, all that's gone up. And appliances, the timeline for appliances, as many of you know, has gone up. The cost of appliances in terms of your wait time for getting appliances or getting electronics has gone up. Some builders are telling me that it's taken 6 weeks to get these dishwashers, these stoves, microwaves, other supplies, because the supply check bottle through China and other countries is still going on. And so meantime, we have a stock market that you can see here, according to the Wall Street Journal, is still above 31,000 now, and it's still going up. How could we have a stock market that's going up and an economy that's going down? Well, we have to look no further than Venezuela, look no further than Turkey, Greece economy. All these economies' currency collapse first, and this is what we're seeing. This inflation is not due to so much to Russia or Ukraine war. It's due to a currency devaluation, a currency collapse caused by money printing and caused by greed of a lot of these companies and people. Basically, that's the truth. So now we're going to this here. COVID-19's toll on U.S. businesses, 200,000 extra closures in the pandemic's first year. Federal Reserve economists suggest small business failures due to the pandemic was fewer than some predicted. But still, these companies, these small businesses around the nation have not opened back up. They've laid off a couple of people. And this is what the scary part is, ladies and gentlemen, is that we're not replacing these jobs with just, remember, those job numbers that you see, those are people coming back to work after the furlough, after the pandemic, or, as we get kind of to a normal pattern. So these 200,000 businesses that we see in all of these cities like San Francisco, Chicago, Dallas, New York, LA, Miami, Orlando, you name it, Indianapolis, Kansas City. These businesses have not opened back up, and they're not opening back up. They're closed down. So we have 2/3 or 130,000 of extra closures. These small businesses that have not come back, and they're still closing locations. And these are technology companies too that are laying out people. Like you heard last week with we've had Stitch Fitch, all of these technology companies that just startup companies are laying off too, because the demand, the consumer demand, the money is just not there. Barbershops, nail salons, and other providers of personal services appear to be hit hardest here, according to the Fed study. And you can see that in many small towns. Most of the barbershops, car washes, nail salons, businesses that we go to every day, even some convenience stores, some individually owned convenience stores have shut down and have not returned. And we can blame that on the health crisis, but we can blame this on the economy, because they can't afford the input cost of supplies, paying the workers a lot of money. And you've seen this a lot in your towns. Liquidation sales. I've seen this on furniture stores, a lot of other places too, going out of business, 75% off. These signs are popping up everywhere, from Miami Beach to all the way up to New York, back over towards Phoenix, Arizona. The PPP, the business loans are over. They allowed a lot of companies and us to ride out the storm a little bit. But now we're going into the third year of this pandemic, or this endemic, or whatever it's supposed to be ending. And the grant money and all of that is ending. Now we're seeing the fallout. We have not seen the fallout, ladies and gentlemen, of all of these businesses that are going to be closed and permanently closed. We have not seen the fallout for that. We will see the fallout from that coming up this fall, and that's why I think we're going into there's a 70% chance, in my opinion, that we're going into a recession this fall. From September, October onward, we will be firmly into a recession because of the job layoffs and the people Americans, all of us, not having the disposable income to spend on entertainment, leisure, travel, hospitality, and retail. Retail is the backbone of the U.S. economy, and that's what the data is going to show. Remember, the data lags behind about 3 to 4 months. The data lags behind in terms of the inflation numbers, the employment numbers, and the other numbers. That lags behind. So we're going to see that. We're going to see that coming up this shortly after this summer. So be prepared, stay prepared, guys. I'll talk to you very soon this week. We're going to have a lot of sessions this week going on. I just want to start off the week giving us an idea. I don't expect the markets to I expect the markets to be kind of flat to a little bit rally, maybe 100, 200 points on Monday or so. They kind of keep it kind of flat line, because there's no major news coming out saying that inflation's at 10%, which is real inflation is already above 10%, but they're not bringing out any additional news until after the Fed's meeting, after the July 4th holiday. That's when things are going to pick up. And so be safe out there. Thank you for listening. God bless. I'll talk to you very soon.